Good morning, everyone. Hi, thank you so much for coming to this session on filling the SDG funding gap with blended finance. Welcome. My name is Liz Diebold. I am part of the Skoll Foundation. I'm very excited to see you all here. It just as a quick introduction to the panel, before I turn it over to Bob, I think we all know that philanthropic capital is very much dwarfed by official development assistance in the world, which is very much dwarfed by private capital. And the Sustainable Development Goals were established and designed quite intentionally in a way that necessitated the resources from all three of those categories and maybe then some in order to be achieved. So this session will establish the role of blended finance in addressing the critical funding gaps to achieve the SDGs. We'll hear from funders and implementers about what's working, where are the gaps, and what we can do to improve. So with that, I would like to introduce you to our moderator, Bob Annibale, who's the Global Director of Inclusive Finance at Citigroup. Take it away.
Great. Thank you very much. Welcome, everybody. I understand this year 40% of Skollies, as I often refer to everyone, is this their first year at Skoll. And that's great. That brings a whole other set of perspectives, and some of us are old hacks, and I hope we can be helpful in introducing ourselves and some of the work many of those who've been coming for some years have made. This is a daunting panel. I've got like 6 illustrious speakers and an audience, most of whom should and could contribute to this conversation because of your own experiences, your organizations, and the questions you'll have. So I'll do my very best to keep it moving. We're really lucky. On my left here is Achim Steiner. And he's the administrator of UNDP. I always think administrator is it's too simplistic a name for really a grand position. UNDP is, for those of us who've always watched the UN, it's a major part of the United Nations network. I think it's the largest group within the UN family. And he has a background. He's both Brazilian, German, he's from South Africa. He's clearly been on the development trail for a long time. And he's been in this position since 2017. But he's also the vice chair of the UN Sustainable Development Group, which is 40 entities of the UN system on sustainable development. So I think that's a very wide range of organizations he's familiar with and agencies working on multiple issues of development, long-term, short-term, strategic, tactical, and I'm looking forward to him giving us a broader sense of that, how he sees it from his level. Just to his left is Alix-Ines Lebec, and she's from WaterEquity, not equality. Water.co was the old connection I always think of. And Alix is really an interesting spin-off or partner of Water.co. I mean, the success of it for many years in bringing together some new facilities for the kind of organizations that have been supporting access to water around the world. Recently raising, I think it's a $50 million fund. And this day will tell us, about a third of that or so is out the door or going, and working with microfinance and other institutions around the world to provide finance. But what's interesting for this group too is how did they arrange that money and funding, and the groups of financiers and equity that they were able to raise from private and public sources will be a part of the story. And just after her there is one of the parts of that story, but is Jim Polan. And he's from OPIC, the Overseas Private Investment Corporation, which is the U.S. government's development finance institution. But there's going to be a bigger new one. There's a new name coming out, which might be called the U.S. Development Finance Institution. Am I?
That's correct.
That's it. Same. Oh, gosh. I mean, I know I was following. We were supporting the legislation and all. And it really will give the U.S. even greater powers. But OPIC has been, for decades, deeply involved in what I think we'll refer to as really private-public or shared finance in development in a whole range of areas. And Jim is someone who we've worked with for many years in that area. He's been there since 1996. And he's been really a director of all parts of it, project finance, small, medium-sized enterprises, He's been prior to OPEC, you were in Botswana, which I find interesting too. And so we're going to get a sense as a bilateral arranger of finance how this fits together too. Just to his left, as I scroll here, is Kola Masha from Babban, Gona. Now, what's so interesting about his organization is it works as I believe it is actually, are you a for-profit entity? Yes, you are. You're a for-profit organization that works with small sharecroppers, small farmers, smallhold farmers, to attract youth in agriculture and really to work away from the extremist groups. It began in northern Nigeria. So it couldn't have picked a more challenging place, but really to help to ensure the livelihoods and the stability and the growth of those industries. He's got a history you'll find in there of working with one of Nigeria's largest agricultural conglomerates. He's worked in corporate finance, venture capital, and elsewhere. And he brings a very interesting combination. We take a for-profit approach to working on some of the issues that he does, but how he blends with nonprofit. Then finally we have at the end Sam. Sam Choritz is with CDF, who I've known for a long time, the UN Capital Development Fund. Is that right? Good. I got the acronym I can think of in my sleep, but I'm just not sure. It's so embarrassing if you don't. And he's got a history of also working in other places. In Ethiopia, head of resident coordinator's office. I think you're from South Africa originally as well. But CDF, amongst the UN family as I've worked with, really works on the least developed countries, a lot of very small island nations and others, quite very challenged small countries or low income, very low income. And I think he's also the co-author of a report on ourselves on blended finance that I'm going to ask him to speak to. So I'm going to kick it off then now with this group and letting them speak a lot more freely because we want to make sure we have enough time for you to speak. But the subject of blended finance, I hear it more and more now. People come to me and talk about blended finance all the time. And I always stop the first thing because it's something new. And then I think about it, it feels like we've been doing this for a very long time. Sometimes you used to call it public-private finance, and it has many names. But blended finance is a current one. And I think what people really often use different definitions. But it is that leveraging in some ways of sometimes philanthropic, other times, softer or public funding, people with different risk and return expectations that come together with private finance, which may not or maybe even profit maximizing, but certainly the theory is that they wouldn't have gotten there without the partnership, without the blending of finance, which could mean equity, sub-debt, debt. It could be a whole combination. It could be guarantees. But what makes blended finance so important to the work that many of you do, and many of my team? I mean, we work with OPIC and other agencies quite extensively in local currencies and local markets to get financing to institutions that, to be honest, would be very hard for us to do on our own, or to go to the tenor we would have gone to, or take as much risk as perhaps is required. And that's really where blending of that type of finance comes in. But I want to ask each of you from your perspective, you speak to an audience who, one way or another, I assume, has worked in this space or looked at it. Where do you find blended finance in the core of your work, and how should others approach it? And can we start with you, please? Because you've got perhaps the best, I think, the broadest perspective, Achim.
Well, thank you, Bob, and good morning to all of you. I'm not sure if it's the broadest perspective, but it's certainly a major preoccupation in anyone's mind who is trying to address the question, how on earth are we going to live together with 9-10 billion people, and how are we going to make the kinds of transitions happen that the Sustainable Development Goals foreshadow and have set out for us. And I think to those of you who are familiar with the 17 Sustainable Development Goals, what they're essentially represent is a kind of collective view of the challenges that we need to address both by 2030 and beyond in order to get to a stage where development achieves many of the underlying aspirations that we consider to be part of our individual hopes and dreams, but also the ability to literally live together in a global economy where people are consuming, polluting, looking for ever more, at the same time confronted with a planet that is under ever greater stress. So that's the setting. in that setting, finance becomes central because the transitions we are talking about in the context of what we know today, energy transitions, mobility transitions, urbanization, access to energy. Remember, in Africa, there's 1 billion people who live on that continent. 600 million of them still don't have access to electricity in the year 2019. The urban infrastructure that we will have by the end of this century is going to be double of that we have today. So the first departure point has to be, and that's why blended finance begins, I think, at the macro end of a view of this, with an understanding that public finance and philanthropic finance in themselves cannot finance this. And therefore, blending, leveraging, becomes a critical part of understanding how on earth this is going to happen, because we do not lack funding and finance. And that's my second point in the economy. $300 trillion is the rough estimate of wealth in the world today. If that wealth essentially is investing in the opposite direction, then public and philanthropic finance, which is pursuing the transitions, no chance of winning. So there is both a necessity, an imperative, and a logical reason why we need to look at blending as a way of, first of all, getting more finance invested in the transition. Secondly, to get the financial markets, in an abstract sense, to invest in the future of our economies rather than in those things that come out of the past and, yes, may generate a lot of income today, but ultimately do not take us forward. Another important part that I have found very interesting with the Sustainable Development Goals is how the financial world has responded to them. Some of you may remember the Millennium Development Goals. They were far more developing country focused. Remember, the SDGs are a global agenda. They're universal. They have been signed up to by all countries, and they do not only speak to developing countries or developed countries. It's, in fact, a shared agenda, because the financial world is a global world. And so this is actually a very important part of the SDGs. And in the finance world, very often what the SDGs become, it's a risk map. If you basically de-risk those 17 areas that are captured in those boxes, you're essentially de-risking the future of investment and finance. And that is why we're having such interesting conversations today with the financial world, because the financial world can invest in anything. Now, can the SDGs become the new, let's say, meta framework within which a financial market, in the abstract sense, investors, hedge funds, private equity investors, actually see an opportunity? And here it becomes very interesting, because this is not an era in which public finance or philanthropic finance become less important. In fact, they become even more important, because they are the trigger, the catalyst, the lever by which we can actually, let's say, incentivize the larger financial system to invest in cleaner energy rather than dirty energy, cleaner mobility rather than the kind of harmful mobility we have, an urban infrastructure that is much more efficient, is conceived differently than it has been in the past. And I think what we have seen, for instance, in a domain that nobody would have thought possible 10 years ago, green bonds, green finance. First of all, renewable energy today attracts over $300 billion in investment a year. This is more than oil, gas, coal, and nuclear combined. This is an energy revolution that has actually begun to transact through the financial lens of investing in development, and increasingly is attracting private finance. See green bonds. Last year, I think over 150 billion now. 10 years ago, it was $1 billion. And for a number of years, it hovered, and I mean, you could speak to that probably better than I do, at around 500 million, $1 billion, and suddenly there was a takeoff. I anticipate that with the SDGs, we are in a similar stage right now. A few SDG bonds have been placed in the market. They have been oversubscribed, but it's a tentative, cautious moment still. But you will see, I believe, in the next few years, the same vertical curve, where we are talking about literally hundreds of billions finding a way into this, let's say, investment track. And that begins an era where we actually can then say that SDGs are achievable, because the economy is beginning to invest in their realization. And I just end by saying, and I'll leave to Sam in a moment, a little bit the sort of product end of blended finance, which is the UN Capital Development Fund's specialty and experience for over 2 decades. At the broader level of the United Nations and the UN Development Programme, we are now very much looking at SDG impact as a way of helping countries to create the conditions under which their domestic financial markets initially begin to invest in these kinds of outcomes that have both a return on investment, also an SDG or a public purpose dimension to it. And that may not always be impact investment. It may just be that you actually invest in something that is aligned with a national or a global objective. The final thing just to point to, which we are also, and I'm currently co-chairing with Maria Ramos, who was the CEO of Absa Bank, the digital financing task force for the SDGs. Because technology is another major enabler for us to be able to connect people, to engage capital, and to create entirely new economies of finance in countries that traditionally would simply have been bypassed by the financial actors that determine where the big flows of finance go. So it's not only large players. We're actually, and this is one of the key roles for us in the UN, we are focused on leaving no one behind, which means we actually start from the opposite end of the spectrum, which is to say, how do we make sure that 1 billion or 2 billion African citizens are not left out of the financial economy of the 21st century, which is fundamental to be able to look at the realization of the SDGs or indeed national development on a continent like Africa. So I'll stop here, and I'm sure in the discussion we'll have more.
And I think we'll think in terms of SDGs can help frame some of this financing, and it certainly helps us use a common language, at least. And I think if we worked with the Inter-American Development Bank on maybe some of an SDG-type bond. I mean, it was it was youth, education, youth, and employment bond. And it really focused on some very specific themes that would be SDG themes, but they also focused on, there was an investor audience specifically interested in education, in youth, and employment. And I think that's where the financial markets sometimes can help target some of this need and these opportunities, just as in the green bonds. But Sam, as we look at this, in many ways you've looked at also the opportunities, but the risks involved in shared finance as a center of the plate approach, perhaps, to development. I mean, where does it fit in that development, and what were some of the findings that came out of your work?
Thanks very much. Maybe to focus then on because I think blended finance is so interesting, because it's sort of a microcosm in so many ways of all the issues you look at in development regarding ownership and transparency and impact measurement. All these things sort of boil to the surface when you talk about blended finance. I think one of the reasons why we looked at this focus on what does blended finance mean for least developed countries was this idea that these are some of the countries least on track to meet the Sustainable Development Goals. They may have some of the biggest financing gaps. And like we've discussed, there's this big gap that private finance could potentially fill. But what does it really mean, and where is it landing in that space? And I think that there's sort of three sorts of issues, and each one has a positive and maybe a sort of risk attached to it that I wanted to highlight. One was this focus on quantity. So there's a lot of talk on billions to trillions, and we need to go from billions to trillions, because that's what the estimate is for where the financing gap is. And I think that's obviously a really important discussion, because the gaps are enormous, as Akim was just mentioning. I think there's also a quality aspect that needs to be part of that discussion. So it's not just about more finance, but it's about what does that finance actually do? And that opens up this discussion about impact and what are we measuring, what's the additionality of that, but also about where is that money going? So is it leaving these countries that we're looking at, the least developed countries, the world's 47 poorest countries, is it leaving those countries behind? Or is it just going towards middle-income countries where it's easier to find deal flow, or where it's easier to sort of find projects that can generate higher returns? So I think there's this balance between it can have really strong impact, but we need to look at quality, not just on quantity. I think that one of the other things that I think becomes sort of really exciting about blended finance is that and you sort of alluded to this, Bob, is that it can sort of narrow this gap between the perception of risk and the reality of risk. And in many ways, that's the theory, that it can support the development of local capital markets. It can show what's possible by showing that a deal can happen, and that can attract private investors on a more sustainable basis by narrowing that gap. The risk here is sort of from that famous paper in the 90s, it's called The Folly of Rewarding A but Hoping for B. It's that idea that, well, just by doing a deal, that may be narrowing the risk, but unless you're actually then trying to build local capital markets, that may not happen. So we can't just have a deal, because deals are really important, they can be impactful, but we need to think about what does that mean in the sort of longer term. Otherwise, you can fund lots and lots and lots of deals, but we're not leading to systems change and market change. So I think there are really important aspects here. I think one of them is really trying to focus on domestic investors, not just international investors. One of the findings in our report is that the second biggest private investor in least developed countries is actually domestic investors. A lot of it's banks through credit lines. But we need to focus on those domestic investors because they know markets better, they don't have currency risk, they're often more willing to take risk that outside investors don't have. And really deliberately then capturing those lessons and working with governments to learn from those lessons to introduce the regulatory reforms, the policy reforms that can improve investment climates. And then I guess the final point I would just make is that there's this issue around sort of trying to leverage more resources. And intuitively, more sounds better. You sort of want every dollar of public finance to attract sort of $3 or $4 is the call in some ways of private finance. And obviously, if you think of billions or trillions, that makes a lot of sense intuitively. And in LDCs, obviously, with the financing gap being as high as it is, you think, well, that's great. And I think the note of caution that we would strike here is that we need to be sort of careful a little bit what we wish for, because the harder you push for hard mobilization targets of 1 to 4 or 1 to 3, people are going to start gaming the system. They're going to put public money into deals that are going to take place anyway, so you can get sort of high leverage ratios. You're going to see more of the DFIs working towards middle-income countries or infrastructure projects, all of which are important, but you'll get more predictable, longer-term return basis. And then I think one of the other things is it opens up this question of what instruments are we talking about. If you're really trying to get high leverage, you're basically going to do venture capital. So you may have a few failures, but when you succeed, you're sort of going to hit a bonanza. But are those the kind of the right instruments that we need to be sort of using to support long-term sustainable development? So I think those are 3 opportunities and 3 sort of flip sides that we've sort of highlighted. And we have a lot more data, which I'd be happy to sort of go through.
That's very helpful, I think, in framing it. And a good transition then, I think, to Jim. And then we're going to get to practitioners. I think we're actually trying to avail of funding. And Jim, I mean, we've done so much together. It resonates with what you mentioned, because I think what's unusual with OPIC is, as we are, because we happen to be in 100 countries or so, is that they're willing to do what many multilaterals and others are not. They'll deal in local currency, under local law, in in local environments with financial, whether it's us or other financial institutions and others, which really is about developing the history of an institution in their local market. Using that, it's more than financing, it's about helping them in the context of their own market to build a history. It's not just cross-currency funding from New York or London or Geneva or whatever. So Jim, maybe you can give a context for how you've used, and OPIC uses blended finance, if you will, which is a long history.
Sure. Thanks, Bob. Bob's a big client, so he treats me. The Overseas Private Investment Corporation, as Bob mentioned, is the U.S. government's development finance institution. And in fact, on October 1st, our name will be the U.S. Development Finance Corporation. And we will be having a lot more authorities. I'll get to that in a second. Up till now, we've primarily been an institution that has provided political risk insurance to companies that are concerned about a whole host of risks investing in low and middle income countries, and debt in senior, mezzanine, and in some cases subordinated debt. That is a very limited instrument, and we have found over the years, and this goes back to the 80s and the 90s, that we need to bring in other kinds of finance in order to get projects to actually take off. And we didn't call it blended back then. I don't even know what it was called, but mixed or something like that. But blended finance per se is not particularly new. It's just, I think, that governments and regulatory regimes have recognized that in order to actually go from your billions to trillions, or at that time millions to billions, we needed to have a whole panoply of not only financial services, but technical assistance and grants and other kinds of help to companies in order to develop the private sector. So, as Bob is alluding to, one of the ways that we're able to get through to thousands and thousands of borrowers is to use our loan guarantee facilities with local finance institutions around the world. And we have some very innovative, what we call loan guarantee facilities, where we work with banks, and Citi, of course, is a major one, just because of their presence in so many countries that we're interested in. But we do also do these guarantees with indigenous banks around various countries, and particularly post-conflict in places like West Bank and Liberia and Afghanistan and Iraq that are very difficult to work in. And in those cases, what we do is we gather technical assistance, not from ourselves, but from USAID and other Swiss and Dutch and other aid agencies to provide training and assistance for local financial institutions to understand how to make loans to SMEs and impact investors. And we don't need to do that with Citi because they already know how to do that. They just need some help with their risk profile and their Basel requirements. So we provide guarantees. They can be 50, 60, 70%, sometimes even a lot higher depending on the need. And we find that over time, which is the most interesting part here on the guarantee side, is that some of these facilities, the banks come back to us after 5 or 7 years when their guarantees are running out and they're asking for the second facility to reduce the percentage of guarantee so that they can reduce their fees and take bigger risk and make more money in their own countries and understand they have learned how to make these loans, which for us is a massive win. And on the other side, we've worked with one deal that is close to our hearts with Citibank and Ford Foundation is a way that Citi can reach clients and names that they like, but they're not ready for commercial banking. And these are inclusive finance folks. They're all in low, middle, and some upper middle income countries. But the idea here is that we've sort of cut out the middleman in that we will provide significant guarantees. Ford Foundation will also help guarantee, and then these companies will be lent money from Citi, and Citi will help them to become clients, regular, normal Citibank clients, and then those guarantees will fall away. And that way, they've already had this relationship, and Citi's finding the names, they are working with them, and it's not just they're not just doing this because for the guarantee. Trust me, they're doing their due diligence on these names. So we're picking up some transactions that are very likely to succeed. And that's just one small element of the blending that we do. Here we have clients that we're with WaterEquity and hopefully Babban Gona that we're lending to. I've got development impact bond projects which is almost a definition of blended finance, where you've got 5 or 6 different kinds of investors. And I would say that probably 60 to 70% of the transactions that we do in our unit at OPIC, which is about $1 billion a year, are blended. We have equity, we have sub-debt, we have TA, we have grants, we have public money, we have World Bank guarantees on some of the renewable energy projects. We have philanthropic money, and we've got for the development impact bonds, we have offtake funders. So I'm happy to talk after with anybody on the details, but just very briefly, we will in October 1st be changing, and then we will also have some of these other facilities like equity, grants, technical assistance, in addition to the debt that we have now.
Great, thank you. And I should just say, I know Jenny's here from KfW as well, the German agency that has, since post-war, has been involved in really an extensive areas as well in the space of blended finance. And you do equity, you've done funds, we've worked with you in many, many countries. So I just make a point of catching Jenny at some point too, if you're looking at this area. Alex, WaterEquity, I mean, you're the outgrowth of Water.org, which we all know from the years of Gary, representing it so well here at Skoll. Tell us how you've transitioning in many ways from Water.org's long years of financing and making the case and demonstrating the viability of initiatives, sustainability of initiatives about bringing people fresh and healthy water and access. How are you taking that to a fund and to a commercial level? And who are the players that the cats you had to herd in order to make this come to a $50 million transaction?
Great, thanks, Bob. And I did want to acknowledge that we have our CEO in the room.
Gary here?
Who's
there he
listening
is,
to the discussion. So, as you state, Bob, over 15 years, WaterEquity has really specialized in partnering with microfinance institutions all over the world and providing philanthropic capital to those institutions to help them develop microloan portfolios specifically geared to helping people get access to water and sanitation. And so over that 15-year period, we've seen these MFIs succeed in providing these loans. I mean, to date, those MFIs have reached over 16 million people. However, a big barrier to scale in terms of these institutions being able to meet the level of the demand that they're seeing out there for these types of loan, there's a key barrier, and that is access to affordable financing in terms of investment capital. So that's really where WaterEquity stepped in. As soon as we started, which was with $11 million fund in 2015, we already had a deal flow that had been established by Water.org, so ample opportunity to invest in these microfinance institutions. And so our first step was launching this $11 million fund. It was an equity fund. Granted, our investments are debt investments, and we really pulled that capital first and foremost from what I would say are friends and family, so high net worth individuals and foundations. As we started to build that track record, since this fund is now fully dispersed, we saw an opportunity to launch this $50 million fund that is now investing in microfinance institutions in India, Indonesia, Cambodia, and the Philippines. And to pull this capital, we had to get creative because we are working with a variety of impact investors that really span the spectrum, right? So that have very different risk-return expectations. And we also had great insights and advice from partners such as OPIC and Bank of America, who for many years were looking for an opportunity to invest in water and sanitation. There just wasn't the deal flow or the opportunity to do so. So we created a structure that has two equity classes, one of which plays a more concessionary role. Those equity classes are leveraged by a catalytic debt facility that includes a loan from OPIC, as well as a 0% loan from Bank of America, another loan from IKEA, and then high net worth individual investors. And that fund structure is further supported by a $5 million first loss philanthropic guarantee, so a cash guarantee. And, in terms of raising this capital, I would say, it's certainly a challenge. I think where we're really excited is this is just the starting point in terms of really demonstrating to the impact investing community that, years ago, the only way to contribute to water and sanitation was through philanthropic grants. Now there is a track record and a real viable opportunity for investors to invest. Our hope is that as this market continues to get built, eventually it will scale and sustain itself on a commercial basis. And then I would state that, in bringing these types of investors together, when I state that we had to be creative, if you look at the structure, which is complex, there's so many layers of capital that is playing a concessionary role. For instance, the 0% debt capital enabled us to slightly bump up the equity returns. And again, that $5 million first loss guarantee allowed us to have the capital cushion necessary to bring in Bank of America and OPIC.
Wow. You really did layer the cake to get there, And I have to say, it's a great achievement. I mean, and it's a lot of work. I mean, to find a line and outcomes that people are looking for, a common outcome in terms of where finance will reach in terms of water and sanitation, but with different risk appetites and different tolerances. You did a great job of that, and thank you for that. And then let's just, Kola, yours is an interesting story because you're an actual operating company, if I will, in many ways, aren't you? And you, by geography, by area, it's only, you'd find normally you would say very specialized financiers would work on agri, smallholder farmers, particularly in northern Nigeria. And you're needed probably for local currency ultimately, right, to finance. And how do you blend all of these tools, and how have you taken forward as a for-profit company too?
Thank you for that. Just so I can get a sense of the audience, I can kind of tailor some of my comments. How many folks here are social entrepreneurs looking for ways to blend some of the grant capital that they have today, by a show of hands? And then how many are individuals who are looking to see how they can deploy capital to support that? All right. So basically, I think for us, it began with a recognition of the scale to which we had to get to actually solve, to have a real impact on the problem. So fundamentally, we took on this challenge, recognizing that in about 5 years, from 2005 to 2010, not one, not two, but 3 insurgencies had taken hold in Nigeria, growing to become, I think one of them becoming the Earth's deadliest insurgency, killing over 20,000 people. And recognizing that reality at the core of that was the fundamental fact that as oxygen is to fire, so are unemployed youth to insurgencies. And so we needed to figure out a way to get those unemployed youth economic opportunities. So we said, all right, if we wanted to solve that problem and not solve, but at least have a dent, we'd have to support about 1 million young rural individuals. And to do that, simple math told us we needed close to $1 billion. And so we asked ourselves, what kind of model and how can you attract that type of capital? So we set out from day one trying to structure our operation to accomplish that. I think the first thing we did was to ensure, that we needed to scale very rapidly, so we believed very much in focus. So we picked a very discrete business model that we thought had the ability to scale to 1 million people, and that's small-scale maize farmers. To understand small-scale maize farmers, I moved to a small village and actually rented 1.5 hectares and became a small-scale maize farmer. And very unsuccessful one, by the way. Then we said, all right, now we understand how the challenges and the risks of so on and so forth of small-scale maize farmers. If I'm going to attract $1 billion to small-scale maize farmers, I have to make them low risk. Then we went through an extensive process to basically understand their risk and mitigate those risks in a model we call our 8 levels of risk mitigation that's enabled us, we're now in our 8th year, deploying tens of millions of dollars to smallholder farmers and have over 99% repayment rate. So now you had a distribution channel for that was low risk. The question now was, how are you going to actually now fund that? Thankfully, I received a phone call in 2013 from a gentleman called Ed Denier at the Skoll Foundation, invited me to the foundation, to the Skoll World Forum, where I met a gentleman called Frank Altman from the Community Reinvestment Fund. And they had started in 1995 doing something similar to what we wanted to do, catalyze capital to disadvantaged communities. And they started out with a similar balance sheet to us, around $5 million, and the question was, how are you? And they got to about $3 billion balance sheet in a relatively short period of time. And so Frank was very kind to take us under his wing and understand how he was able to blend capital to accomplish that. So we learned that model, and then we put it into practice. And so the basic structure was, we went out and we found organizations that were willing to provide us an equity layer. We got the Gates Foundation to come in and do a very innovative investment where they basically gave a grant to our farmers to own equity in the business. So our farmers own nearly a third of the business, closer to 20% now. And off the back of that, we were able to structure, once again, with Skoll Foundation, with Ed Denier and Shivani helping drive that, we were able to put in place a well-structured subordinated debt structure that was able to catalyze in about $5 million in capital from foundations and social investors. And off the back of that, $9 million now of subordinated capital, we were able to go out and raise nearly $15 million in senior debt from leading development finance institutions. That whole process, I think one of the things that we've been able to accomplish there is to make that process now very efficient for investors. And now with Jetty and KfW kindly coming in now to help us replicate this. So they're coming in with a much larger equity contribution. The European Union's coming in to take in a much larger subordinated debt position. Then we expect that we can at least double the size of what we've raised to close to $60 million in the next year or two.
Wow. That's quite the menu of players as well to come up with that. I'm going to open to Q&A, but I want to ask Hakeem something, and then maybe Sam from your work. Is there a risk, though, of donors? Because in the sense of the UN, you really have to be sure that your member states contribute. Right? Your member states don't particularly lend to the UN, do they? They have support in terms of their grant or funding and the contributions, and we've seen when some of them pull out what that can mean. But is there can there be a false expectation that you can achieve all of this with less public money, as opposed to we need more public money in many ways to achieve even a greater outcome. But we look at some of the areas of social finance that are working on, and they will require a public good in longer term. So can there be a mixed message in all of this?
Well, some people try to introduce a mixed message, but let's first of all start with the simple fact. The risk of not scaling up public finance in order to leverage additional investments is just so enormous that we no longer have environmental activists or social activists being the ones who are articulating the need to act. We have leaders of financial institutions, political entrepreneurs. They are calling for a public finance response. And remember, we lived through a period when, after the 60s and 70s, government would regulate everything, development would come out of public policy. We swung into the opposite era when, the less state, the more markets, the better. Both of these polarities still exist, but the actual center ground is much more solid. And even on ODA, let's recognize that development finance at the moment is not going up, but it's also not gone down. There are a few countries who are retreating and exiting, but a number of countries have actually gone closer to the 0.7 target. We are talking about $140, $150 billion ODA, and we have a significant new player in this, which is the impact investment community. And just China and the US have 900 billionaires. That's $1,000 million and more that individuals own. Just 1% of the global wealth could actually finance the entire SDGs. So I say that simply by giving us a little bit of perspective, because the temptation is to talk about the future investment in terms of the most conservative perspective of those who actually run our financial system today, which is an incredibly risk-averse, traditional, and backward-looking community that is defining the entire horizon of investments. Mm-hmm. And this is what we're trying to change. And so, listening to Alex just now and also to Kola, one of the things that I believe firmly in is also a role for institutions such as OPIC, UNDP, and others in the public space, KfW, is to challenge the financial markets in terms of the narrative that is being set by a very narrow perspective on investment. Mm-hmm. That's why the SDG Impact, which is a startup that we launched in UNDP, is a frontal engagement at the level of countries. I think that's also very important. Not everything has to be foreign direct investment. Many countries today will remain on the sidelines of the global highways of foreign direct investment. But those countries have capital in individuals, in banks, and so on. And what we have to do is help governments create conditions in which that domestic capital begins to invest in outcomes that, call them SDG related or not. I mean, we can find different articulations. So my point would be, I think some countries are withdrawing, but actually, if you look at the realization of how we look at the world today, whether it is cybercrime, whether it's water scarcity, whether it's climate change, actually many more players in the economy are asking governments to be more proactive. And just to give you another example, the Sahel region. And the narrative with which we as a world community look at the Sahel is one of complete negativity, poverty, crisis, droughts, starvation, violent extremism. You just spoke to this. When in fact, there is a completely different story that could be told, which is millions of young people extremely keen to become educated, engaged in the economy, a community that has only reacted to the Sahel region in crisis moments with humanitarian aid and then withdraws. Finally, because the threat of what is building up there is now registered on the radar of particularly Europe, we are finally talking about engaging in that region not only with the notion of solidarity but actually co-investing in an economy that over 20 or 30 years could become the next big frontier of development. And that's what we're talking about, I think, when we have to challenge these narratives.
Yeah, we have to get you to speak to groups like Basel Committee too, because unfortunately the Basel Committee has said all the areas that you're working in are the highest risk areas and should require the maximum capital requirement of banks and the highest loan loss reserves, which makes the threshold for local financial institutions and others where this has trickled down.
Can I just say,
really challenging.
Absolutely, exclamation mark, but this is part of that same narrow governance of finance that I think people like Mark Carney and others have begun to challenge. Some of you may know the inquiry into green finance that the United Nations Environment Programme led for a number of years. It began precisely because of Basel.
Yep.
Basel was the biggest hindrance to actually getting mainstream finance institutions to invest in green finance.
Basel is the regulator's regulator, if you think of it, really. The worst.
And
That challenge.
Bob,
Please, go ahead.
I just, because there's so many things that you stated that are just really resonate with our experience, and I think numbers are always helpful in terms of framing. And, I know certainly with investors and people that we've interacted with, what I've often stated is you look at remarkable financial institutions such as UBS, right, that also plays a philanthropic role. UBS has $2 trillion in assets under management. It provides about $170 million in philanthropic capital per year to support philanthropic endeavors. That's the pool of capital that we are working with to solve the world's greatest challenges. So if blended finance is going to be that bridge from that $170 million to that $2 trillion in assets under management, we need development finance. We need concessionary players and a lot more of it from foundations who can also help change this investor mindset that you're mentioning, which is significantly always focused on, is this impact investment going to generate a market rate return? When really we should be having a conversation around what is the extent of the social and economic impact that my investment is going to have alongside a modest financial return, because that's really the only viable way that we're going to pull in the trillions in dollars that are needed to solve the SDGs.
Yeah. Sam, I think you might have a comment, and I'm going to open it up. But I know, Jim, you just did a deal in Sahel. Didn't you just do something in Chad?
Yes, we did.
Which is not an easy place to do.
No, it was rather challenging, but that's what our new focus is on, the lowest income countries and the most challenging ones. And we went there and talked to a lot of folks in the government and in the private sector, and we made it clear that we weren't shy. We said we're the U.S. government and we're here to help, and we're going to work with the private sector, and we want certain assurances, not necessarily in writing, that you're going to basically leave us to do our thing. And we did get those assurances, and we closed a deal, and we hope to do more.
You're an agency whose Congress expects to get repaid, right?
Yes,
You pay dividends, actually, to the U.S. Treasury every year.
They do expect to get repaid, and they expect a lot of other things, too.
Sam, I'm going to open up the floor. But is there anything on this point that you want to
No, actually, Akim's, one of the other hats he wears is the managing director of UNCDF. So I sort of agree with no, I would just add that I think it's really important to see public and private as being complementary. They have different mandates. Private obviously has a profit orientation, public doesn't, but the two need to go together, and that's where this conversation, I think, becomes really interesting. And there'll continue to be a role for public finance in areas where there isn't a profit motive. Biodiversity is one of those areas where there could be, but it's maybe quite tricky. Free education, free healthcare. So that's one thing I think to think about. And I think the other is people are looking for deals, but actually who's supporting the pipeline preparation to get those deals ready? And public finance or philanthropic finance has a really important role in that side. So the idea of just attracting finance to deals have to come from somewhere, and it's a lot of the hard slog, a lot of technical systems, grant funding that's actually preparing deals. So if we ignore the public side of this, particularly at this juncture, there isn't going to be a sort of home for the private finance to come into as well.
Yeah,
Absolutely.
I think just to add to that, I think where we have seen the most value of philanthropic capital in this space is how they're able to de-risk the deal to catalyze in the additional capital. Now, typically people think about de-risking that deal in terms of providing some sort of guarantees or subordinated capital. But there are other ways that folks have been able to do that. I think one thing the Skoll Foundation did very effectively was really fund all of the legal work, right, that needed to be done to get the structure right, so that you have basically a cut and paste transaction document that you can go out and raise, $1 billion. There are very kind of strategic ways that people can focus on that. But one thing I have seen a little bit of a trend towards that's a little bit concerning is a mindset around if you are the goal is to attract commercial capital. Commercial capital needs to get a return, right? And they're going to expect a larger return, and if that's and what you often find is the philanthropic capital more and more these days. I find that there's a concern around fairness, that if bank X is getting X return and I'm taking more risk, why should I not get more? And I completely hear them. But if that was the case, then you would not need. If that type of capital, this type of a structure could happen, like I could go out and raise sub debt today at 14% APR. Right. There's a bunch of people that give me sub debt at 14% APR, but there's no way I can support a smallholder farmer to get 3 times national net income, passing on 14% APR dollar return. Right, and so I think that's a very critical piece that I think needs to be focused.
Yeah, and I think a tax-exempt nonprofit whose sole purpose should be a public good, in many ways, does have that commitment already by its very nature of its funds and then its legal structure. I'm going to open it up to the floor, but I just want to ask Jenny, do you have one? Can I be cruel and ask you something? Jenny's just up there. KFW combines a lot of things. It sometimes has grants, like technical assistance. It has equity, you do debt. How do you look at this menu? And, I also, this idea of the blended finance, where you want to be a part, but how you want to exit.
Well, if my management heard you, that's one of our biggest challenges is exits. And we haven't gotten a good track. I mean, for the beginning, we did open-ended funds and never worried about exits, and suddenly those funds were growing. Now we have over 70 funds, all blended. And our management was like, well, and that's, what are you going to do about it? So, a couple of things. Yes, KFW, I think in this space, is known very much for blended finance, but just to emphasize that the majority of what we do is actually sovereign lending, so very classical, bilateral. And I think, to me, that is one of the biggest challenges if you really want to tap into the deep pockets. I don't know how other people feel about it, but it's bilateral. It's in the sovereign lending. And there's so many panels I sit, and they say, oh, we need concessional funding. I'm like, we're spending billions to your governments, except those governments never give it to the private sector. Yeah. As much as they talk private sector, they never give it to the private sector. They only give it to state-owned enterprises and state-owned banks with, let's say, a mixed track record, especially in Africa. So that is to bear in mind. And I think if we're talking about leveraging and deep pockets, that's where the real money is, in bilateral cooperation. But as a footnote, when it comes to our work in blended finance, so we do have special dedicated funds that go to regional projects, which we do invest in funds which are normally structured. So we take the equity tranche and then there's debt on top of that we try to get, or it's a structured equity fund with different return expectations where we loop in private capital. We have over 70 of those funds, they're debt funds, they're equity funds. They normally come with technical assistance. In addition to that, we have, and that's probably for this space the most interesting bit, is we have, as of recently, the government has done special initiatives, especially in the ag sector, which after 6 years of trying to work with Kola, finally gave me the ability to do that. And that basically is a One World No Hunger. It's a special initiative targeted at food security and agriculture. And it allows us to do individual, not only funds, but individual investments in the private sector and also in the non-for-profit space. Mm-hmm. So equally, we we gave money to One Acre Fund and MyAgro, but that is very special and as a special initiative. So that's the portfolio of what we do. And the question I think I have to the panel, and what sort of drives me is, blended finance is a very illustrious term, and it's been used for decades, and people understand different things by it. What I'm grappling with right now is to what end? So, because we can blend as much as we want, and a lot of the funds where we blend are not particularly successful, because it turns out the costing structure of those funds is very expensive. In the ag space, many of you may be familiar with the work that the Council for Small Agricultural Finance has done. Below $1 million deal size, they can't break even. They lose money below $1 million. Now, most of the ag SMEs that I've seen need less than $1 million. So who's providing funding to them? Citi, wonderful example. Like below $1 million, and we just had, with Eugene, we just had breakfast. Oh, well, below $1 million.
Right.
So that's the challenge. Like, what is our theory of change collectively to actually ensuring that in the local markets we find institutions that are providing the capital that is needed by the smaller SMEs that will drive the growth? Me personally, I'm super excited about local institution building, but that's something no one wants to hear because it's expensive, it takes a lot of time, and it is a difficult type of funding that is needed. Kola, for me, you are one of those local institutions. Mm-hmm. Yeah, you're part of the financing landscape in Nigeria. You're doing what the microfinance world isn't been able to do, provide that kind of deal size to the farmer. So, to me, I think we need to shift the debate from just blending to blending to what end? What is the financial sector that we are expecting to see in those countries, and how collectively can we build those local institutions? Because the funds, which is our prime vehicle for blending, is not going to do the jobs because they're simply too expensive. And mostly they don't have local currency. And that's something, when you talk about blending, that's often forgotten, is you blend, but we blend in euros or US dollars. And unless we, and I was also said, unless we can find ways to mobilize the money that exists in the countries, which by nature is local currency, if we can't mobilize that money, we're not going to solve it. So my two big challenges: what are we blending for, and how can we blend in local currency? Because otherwise, we're not going to tackle the problem.
Okay, I had a couple of hands, so I'm going to keep. But I like that, and we use local currency all the time. I think that has to be a must. Otherwise, you're introducing new risks to institutions, which are even worse than no financing. Nigel, can I grab you?
You can. Nigel Kershaw, chair of the big exchange, the big issue. My thing is that actually this seems to me a really kind of product-led debate. If we're talking about the SDGs, if we're talking about meeting the SDGs, it's about the hearts and minds of ordinary people, not the financial structures we set up. So my real challenge is, when we talk about blend, unless you take the billions of people around this world and give them the ability to invest in themselves and their future and their communities and the world around them, then actually we will have this debate endlessly, as we've had for hundreds of years, about doing it, because it's about hearts and minds of people. So it's how opening up to the retail, which was what we're doing in Big Exchange. So we're launching something with 40 impact funds for the ordinary person in the UK to do, and hopefully whatever, because that's how we're going to change this world. And when ordinary people put pressure on the institutions I bet the life those institutions will change quicker than actually whether they think it's a good or a bad thing to do. So that's my challenge. Blended finance is more than what we're talking about. It's about hearts and minds of people that will change this world.
Thank you. Carrie. Gentleman right there. Yeah.
So interestingly enough, Water.org is building a platform just to do that, to give this, to democratize this ability to be an impact investor. But on a different note, it seems like one of the most amenable sources of capital to this would be the capital that's tied up in private foundations. So within the U.S. and Europe, there's about $1.5 trillion that's already been given away. Technically, people have gotten the tax break. It's supposed to be doing good in the world, and it's almost exclusively invested in bonds, blue chip stocks, private equity, right? Isn't it time that we build in a PRI mandate, just like we have the 5% payout mandate for foundations, to bring the type of capital that we need to bridge this gap to commercial capital? And because of that social contract that those foundations have, because of the tax breaks that their donors have gotten, they should be the front lines of providing this type of investment at a concessionary rate. I don't know if you guys would respond to that, or do you think it's possible to change those types of regulations within the tax codes?
Let's grab another question too, Gary, just because I think you made it very clear that is the challenge. The tax code in some ways allows these foundations not to release these funds. Exactly. They release the 5% they have to in the United States to meet with their IRS. But the question is, what about the corpus? Exactly. Right? And how is that really invested with purpose, in a sense, yeah? But anyway, these folks here are going to pass it through, and we'll pass behind you next.
Hi, Maya Winkelstein with Open Road Alliance, and we, among other things, provide short-term bridge financing specifically at below $1 million to social enterprises around the world. And I heard the panel talk a lot about de-risking, right? And the purpose of blended finance to be de-risking. One of the things that we find in our work, though, is that there's a difference between de-risking, which is needed, and just a straight-up misperception of risk. And you know, Kola, I'd be interested in hearing your thoughts on this as well. We look at emerging markets or work, and I think that in addition to, yes, there will always be a need to de-risk to appeal to those different risk tolerances, there is also very clear misperceptions of risks all along the value chain. So my question would be, what is needed for OPIC, for UN, for private foundations, for others, not to de-risk, but to actually change and right-size our perspectives of risk for the realities that we're facing?
I could open to you there. And I just said one thing as a bank. It took building credit policies, debt rating models, demonstrating quantitatively that these segments that many of you work in, are not to go in the default bucket, which would be, as some agents, regulators put, very high risk. But we have actually quantitative history and experience that shows, and we at OPIC and others do that all the time, to really demonstrate, I'm sure you do, Jenny, that the performance is not with a high expectation of default. Right. That there's a large performance, and there is, not about de-risking only, but it's a risk sharing. There are others participating in this that know even better than we may, that the nature of that industry, and that's an important part of it. Kola?
So on that issue, I think there were probably two groups that helped us do that the best. The first was Kiva. So Kiva gave us our first $20,000, right? And we proved we could take 20 grand and pay it back. Then we had DFID that came in and gave us $400,000. And we proved that we could take $400,000, pay them back with interest, and demonstrate to folks that, look, this model is financially viable, right? You can lend to farmers, you can make money, and based on that track record, and I think the other piece there, we also, we actually made the effort. We were tiny, right? But we went through the efforts of actually structuring a private placement bond structure and everything, and that gave us credibility where we were able to go out and raise larger and larger amounts of debt. And so I think the whole piece of changing the perception of risk is being willing to give that capital to allow someone to prove themselves and structuring it in a way that they can prove themselves in a way to bigger amounts of capital.
And can I build on that?
Yes.
I love that question because we certainly encountered that a lot, even with one fund under our belt and a 15-year track record in terms of water and sanitation and microfinance through water.org. And so, I would say that there's nothing like action. And I think that until institutional investors see other like-minded institutional investors invest big in your funds and be part of this endeavor, it's going to be hard to get the other institutions on board. Because even with the data that you have today around microfinance investment funds that have very low default rates for a significant amount of time, they've proven this. I often got the question from investors that, I hear you, but this is microfinance for water and sanitation. This data almost sounds too good to be true. And so, and we understand that, and obviously we're building that track record. But I would reiterate that action is the greatest way to do it. And that's where, when you do have institutions like OPIC and the Bank of Americas that invest, it's a first step. It's great. Obviously, hopefully that incentivizes others to come on board.
Andrew, you had your hand up.
Thank you very much.
Here's your mic.
Sorry, I broke the rule. Thank you very much. Andrew Cairns from Community Sector Banking from Australia. Just following on from Jenny's comment before, which was, I thought, profound. Blending finance for what end? And coupling that with your comment about getting commercial return or getting social and societal or community and capability outcomes and a moderate return. So my question is, how do we harmonise the measurement of impact? And how do you factor that into the conversation and narrative of what you're trying to achieve? And I go to your point, Kola, of how do you put a price on self-determination, capability and confidence?
Hakim, what on that?
If I may just pick up on the points that Andrew and Jenny made, I think the theory of change or to what purpose, to me, I think the purpose is relatively clear, which is to redirect the financial assets that are available to us in private and public domains towards clearly identified goals, and they're measurable and they have an objective. Now, blended finance is not an end in itself, it's a means to an end. So that's the first thing. So the issue here is to what end? To scale up and accelerate the capacity of countries right down to communities. Coming now to individuals. This is not just an abstract notion. To invest in a more viable future economic situation. Out of that, I think, arise a number of challenges. First of all, public policy can be a very critical part of building that ecosystem. So I view a development institution such as UNDP in some ways as a venture catalyst, right? It's not the capital provider, but it is the one that works with government to look at how do you create the conditions for that. And there are very many examples of that. In South Africa, the constitution prescribed the minimum water that is a right for every citizen to have. Above that 25 litres per day, you then can develop a water service economy. And again, an important lesson here was we do not privatize water, which was the big mistake of the 1970s, 1980s, but we create economies in which the provision of services related to water, provision of water treatment can indeed be provided by the private sector, and they become co-investors in the infrastructure. Another example is markets can sometimes create whole new business models. We spent years flogging this dead horse of trying to make solar panels so cheap that a farmer who doesn't even have a dollar in a bank would be able to afford to buy a panel, until somebody came up with the idea, actually, why don't we go with the pay-as-you-go principle? Again, Kenya, building on its own M-Pesa experience, started providing the means by which investors would actually install the solar infrastructure, and the household would essentially get electricity on a pay-as-you-go basis. Suddenly you've cracked an entire problem that attracted now investment on a scale that was needed and didn't make the poor farmer to be the venture capitalist, so to speak, that they could never become. And I think this is a very important part of the objective. Now, I also just want to, if I one sentence only, I think it's not an either-or, is it the individuals or is it these corporate finance institutions? We live in a world right now where, somewhere between 30 to 50 people own half the world's wealth. So you can start with that. And we need to start recognizing that. The individual consumer is equally important, or the individual household, and can also be a mobilizer of capital. But even an insurance company that on the one hand is extremely worried to paranoid about the future of climate change and the impact of its business, that very same institution next door in the same building has the people who are actually investing their money in the capital markets. And what are they investing in? Carbon-intense infrastructure. And this is the contradiction of the system, and I think that's why public policy is a critical part of the theory of change, which enables a different kind of finance investment economy to emerge. Sometimes it'll be crowd finance, it'll be individual by individual with a dollar, and sometimes, yes, it has to be also the big financial sector players that are simply becoming a major liability to all of us by not being able to either be pressurized, incentivized, or change. And I want to come back to your point. I completely agree with you. The inquiry into green finance was essentially an attempt to challenge the dominance of a narrative about green finance that had suffocated a market for years when it actually was already much more mature to move forward.
Well, I think some of us are here and doing just that.
No, I mean, you're part of that very much. Yeah.
It is very much about demonstrating, and I think that we'll end with the idea, though, that I believe the blended finance, as we describe it, which is really about a risk participation of public to private and, of all different sources of funding, is about also demonstrating, the sustainability, the scalability of many enterprises. And in some cases, it will take a little while to build that history, but I think many of the organizations here have been doing that. And the graduation, if you will, of institutions who can now avail of wider choices is really what's important. It's another form of crowd financing in a way. It is about institutions follow each other, just as you might go with people you're comfortable with or organizations you're comfortable with. And we build track records together that I hope demonstrate the viability and the enormous importance of the work you've all done. So to everybody here, thank you very much. And I wish I got to more questions, but please meet anybody afterwards you'd like. Thank you.
Thank you.